Two people each buy identical houses on the exact same day. Same price, same loan, same 6% 30-year mortgage. The first one obsesses about the debt. She pays extra every single month, attacks the loan, kills it in 15 years, and walks around proud. The second one pays exactly the minimum, never a dollar more, and takes everything she would have thrown at the mortgage and invests it instead. Same starting point. 30 years later, the second one is $400,000 wealthier than the first. Same income, same house. The math is brutal, and most homeowners refuse to actually look at it because the emotional pull of owning your home free and clear is so strong. By the end of this video, you'll have the math, the exceptions where paying off does win, and the framework to make the right call for your situation. There's a feeling that paying off your mortgage is the obviously correct thing to do. Debt feels heavy. Owning your home outright feels like arriving. Your parents told you to do it. Every personal finance celebrity yells about it. So most people accept the conventional wisdom and don't run the numbers, because the numbers don't seem necessary. The problem is, mortgages are not regular debt. They are the cheapest, longest, most tax-advantaged loan a normal person will ever get in their life. Treating them like credit card debt costs you a real fortune over 30 years. The emotional math says, I want to be debt-free. The real math says, this is the cheapest money I'll ever borrow, and the spread between my rate and the market return is wealth I can capture for free. Here's the central question. What is the interest rate on your mortgage versus what return you could reasonably earn by investing the same money instead? If your mortgage rate is 3% and the long-run average return of a broad stock index fund is around 7% after inflation, the spread is 4 percentage points. Every dollar you put into investing instead of mortgage payoff earns a real 4% more per year. Over 30 years, on serious money, that compounds into hundreds of thousands of dollars. If your mortgage rate is 6%, the spread shrinks to about 1. Still positive, but much closer to a coin flip when you factor in risk and volatility. If your mortgage rate is 9%, suddenly paying off starts looking smart, because you're guaranteed 9% return on the payoff versus an uncertain 7% on the market. The wealth that gets built between two homeowners with identical incomes isn't built from the difference in their salaries. It's built from the spread between their mortgage rate and their investment return, compounded over decades. Person A throws an extra $500 a month at her 3% mortgage. She finishes it 12 years early, then has $36,000 a year to invest from that point forward. Person B never overpays and invests $500 a month from day one. Over 30 years, that uninterrupted compounding makes Person B richer by roughly $400,000, even though both put in identical total cash. The math isn't a gimmick, it's just the cost of skipping a decade of compounding to chase the emotional satisfaction of a paid-off house. Paying off the mortgage early isn't always the wrong call. In 3 specific situations, it's the right one. 1. Your mortgage rate is high, say 7% or above. The spread inverts. Guaranteed 7% return on the payoff beats uncertain 7% on the market after risk and taxes. 2. You cannot emotionally tolerate any debt. If carrying a mortgage costs you sleep, makes you panic during market downturns, or prevents you from investing at all, then paying it off is worth the dollar cost. Peace of mind has value. 3. You're nearing retirement, and having no housing cost dramatically lowers your required retirement income. Sometimes the simpler retirement budget is worth more than the bigger portfolio. For most homeowners under 50, with a fixed-rate mortgage under 6%, accelerating payoff is the wrong move. Here's why. Your mortgage interest is partially tax-deductible if you itemize. Your effective rate is even lower than the headline number, which widens the spread to investing. Your mortgage is also inflation-protected. Your payment stays fixed while your salary rises with inflation, so the payment shrinks as a percentage of your income every year you hold the loan. You'd be killing the cheapest loan you'll ever have to free up money you could have invested into the longest-running wealth-building engine ever discovered. That's a trade most people would never take if it were framed honestly. This is the part almost nobody mentions. A fixed-rate mortgage is one of the only loans in existence where inflation actively works in your favor. When you take a 30-year loan at 3% and inflation runs at 3% over that period, you are effectively paying back the loan in dollars that are worth less every year than the dollars you borrowed. The bank handed you $1,000 of 1994 purchasing power. You're handing back dollars that are worth a fraction of that in real terms by year 25. Paying that loan off early forfeits this inflation gift. The bank made the bet that inflation would stay low. Every year inflation runs above your mortgage rate, you win and the bank loses. That's not your imagination, that's the math. Here's the other quiet cost of paying off your house early. Every extra dollar you put into your mortgage is a dollar locked behind a wall. Home equity isn't accessible without selling, refinancing, or taking out a home equity loan, none of which are fast in an emergency. Cash and brokerage investments are accessible the same week. So if you've thrown $300,000 at killing the mortgage and then your industry collapses, you cannot easily get to that money. If instead you'd invested $300,000 in a brokerage account, you could pull from it next month. The peace of mind of a paid-off house is real, but so is the peace of mind of $300,000 you can actually touch. The smartest move for most homeowners is a quiet hybrid. Pay the minimum on the mortgage. Always. Then redirect what you would have overpaid into the highest priority investment bucket, usually capturing the full 401k match first, then a Roth IRA, then a taxable brokerage. Once you've built a healthy investment portfolio and have years of runway saved, you can revisit the mortgage payoff decision from a position of strength. Most people never get there because they kill the mortgage first and skip a decade of compounding. The hybrid keeps both engines running. The investments grow while the mortgage shrinks on schedule. The flexibility is the win. Here's a strategy almost nobody talks about that splits the difference between paying off and not. It's called the mortgage recast. You make a single large lump sum payment toward your principal, and then ask your lender to recast the loan. Recalculate your monthly payment based on the new lower balance while keeping the original interest rate and original loan length. The result is a lower monthly payment for the rest of the mortgage without refinancing, without closing costs, and without shortening the loan. This is useful when you receive a windfall, an inheritance, a bonus, the sale of another asset, and want lower monthly fixed costs without giving up the cheap, long-term loan you already have. Most lenders charge a few $100s for a recast. The math is specific and worth running before you do it, because in many cases simply investing the lump sum still wins. But if your goal is monthly cash flow relief without losing your low rate, the recast is a real third option between pay it off and invest the difference that most homeowners have never even heard exists. Let's run the actual math for a real situation so this stops being theoretical. You have a $400,000 mortgage at 5% over 30 years. Your monthly principal and interest is around $2,150. You're considering throwing an extra $500 a month at the mortgage, $60,000 over a decade, on top of every regular payment. Option A, pay the extra every month. You kill the mortgage about 7 years early and save roughly $70,000 in total interest. Real money, real win. Option B, invest that same $500 a month into a broad index fund at 7% average return. After 30 years, those monthly contributions are worth around $610,000. The interest saved by the payoff strategy is real but capped at the loan size. The investment growth has no cap. The spread between the two outcomes, in this real example, is well over $500,000 in favor of investing, and you still own the house outright at the end of 30 years either way because the original loan also got paid off on schedule. Run your numbers with your rate and your expected return. The math is what it is. Here's how to actually decide for your specific situation. Pull up your mortgage rate, subtract the tax benefit if you itemize, compare to a realistic expected investment return, call it 6 to 7% for a broad index fund. If the spread between investment return and effective mortgage rate is 2 percentage points or more, investing wins clearly. If it's less than 1, the decision flips depending on temperament and life stage. Be honest about your risk tolerance. Run a simple calculator with your real numbers. Don't just default to the cultural pressure of kill the debt. The math is the math. Your specific math may say payoff. More often, it says invest. Reminder: this is general education, not personalized financial advice. A fiduciary can model your actual numbers. So here's the whole thing in one breath. Mortgages are the cheapest loan you'll ever have, and the spread between your rate and what you could earn investing is real wealth waiting to be captured, if you choose to capture it. The emotional comfort of paying off your house is worth something. So is $400,000 extra dollars at retirement. You have to decide which one you actually want, with your eyes open and the math in front of you, not based on what your uncle yells at Thanksgiving. If this helped, subscribe. Thank you for watching, and see you in the next video.